that, you put your customer in a position, the portfolio in a position where the different pieces are working in different environments. Does that make sense?
Absolutely. Absolutely.
So talk a little bit about this screen that you have up.
All right. So this is this is our models that we create for our clients. And I'm not trying to pitch this to people, but it's as much as I want people who watch this video to go back and ask your financial advisor for them to create you an efficient frontier. What you're trying to look for is how are your individual accounts performing with the different ingredients? So every account consists of ingredients and recipes. And what you're looking at is in this efficient frontier, if you look at this piece right here, let's get my pen to work. My pen is moving slow here today. There we go. You look at something like that. That model right there has 20% stocks and 80% bonds. But you come over here, 40% stocks, 60% stocks, 75% stocks, 90% stocks, 100% stocks. And basically, the more stocks you put into a portfolio, you go farther right for more risk, but you also go farther up for a higher rate of return. And that's, again, over time. This is using a 10 look at example of this. So we like to, hold on, let me hit a button. Something's popped in here. All right, so we want to teach people that risk can be measured and risk can be calculated using technology. And so I encourage people to go back to their financial advisors and ask them for an efficient frontier of their various accounts they would have with their advisor and look at it in proportion. Are they in line with each other? The accounts that you have more aggressive, the accounts that you have more conservative, are they in line proportionally? Because if they're all over the page, then that probably says that they have a complete, unique mixture of stuff. So I'll go ahead and hop off this. I'll get that back, put you and I back on the screen there. Chris, something I think I've found over years is when we meet somebody new that comes to us, we find that they believe they're diversified and they believe they have less risk than what we discover. And that's somewhere when they look at their statements and they see all of their positions, stocks, bonds, mutual funds, all of this stuff, and then their conversation with their financial advisor, they have it in their head, they're like a certain level of risk. But once we do the analytics behind it, we realize they're actually higher risk than they want, and they're not getting anywhere near the returns they deserve. So in the last 9 years, the market's been going up the way it was before the coronavirus. Everybody's making money, and most people would be making money. They're just not making as much as they should based on their risk level that they have. So their risk is too high and their returns are too low, and it's very easy to calculate that. Don't you agree?
I absolutely do. I had a conversation with somebody yesterday after you and I talked, and they said with everything that's happening with the election and all of the announcements and the coronavirus and everything that's happening in the world right now, how do you make determination what it's time to do? Is it time to buy things? Is it time to sell things? And you know, so much of what we do is built around being disciplined, not reacting to that emotional, what's the word I'm looking for? That letting that gut feeling make a determination what you do with your own money. It's easier to manage somebody else's money, I think, than it is to manage your own, because emotionally we get tied to our own assets. And so, you know, when you take a look at the coronavirus and all of the things that are happening in the world today, invariably when we feel like there's tremendous risk, we want less of something. And that's, as Warren Buffett says, when there's blood in the streets, that's when you should be a buyer. And, you know, invariably it's counterintuitive. If I feel bad about something, it's probably the time that I should be looking to add more to my portfolio. When I feel really good about something, when I feel like I should take more risk, that's probably the time that I should be lightening up and moving away from risk positions. Because our emotions tell us, you know, if we react to that, that's when we can make tremendous mistakes with our portfolio.
Oh, absolutely agree. I talk to folks all the time that will tell me stories, and I'll ask them questions about their past because I want to kind of know them as a person and not really know them as a number. And when you really ask the right questions, people will open up and tell you how bad 2001 was for them and how bad 2008 was for them. But then you ask why was it so bad besides the obvious of losing money? Why did you lose so much money? And it was the idea of, well, I held on too long. It kept going down. I was just waiting for it to come back up, but it went down farther and farther. I always hear a very similar story. And so I agree, Chris. I think the absolute best situation for anybody is when they have a financial advisor, a good financial advisor is going to help you take the emotions out of making business decisions with your money.
Right.
And that's really what it is. It's business decisions, but it's your life earnings. It's your lifetime of saving. It's kind of hard to separate the emotions from that. I mean, I get it why people are that way.
Yep.
How do you get people past the emotional side of, I want to be this way, I want to be that way, get me in, get me out? How do you get people past that?
Interesting that you asked that. Let me pull up a couple of screens. This is one of the charitable foundations that I manage. And let me make sure I got the right one. So this is what it looked like back in June of this year. So as you look at this, and can you see my cursor moving here?
Yeah.
Every time that I go to take a look at a portfolio, I line up and I see, okay, what is my exposure to each one of these areas? And go back to what I was saying about modern portfolio theory. It's about having a diversified portfolio. And this goes back to your ingredients in the chocolate chip cookie. So as I build my fixed income portfolio and my equity portfolio, I have large cap growth components. I have small cap growth components. I have international components, convertible bonds, et cetera. And this is what, when I line those horses up, this is what it looked like on June 5th. These are the moves that I needed to make to bring it back into balance and reline those horses up to the model that we determined that this should look like at the beginning. So if you go back to June, at that point in time, this portfolio was 57% exposed to the stock market, 7% exposed to the bond market or our fixed income components, and 7% exposed to cash. So these were the moves that I made to realign those. This is an emotionless decision. Math tells us how to do this. I'm not making a determination based upon what COVID's doing or what's happening in the election or what companies are out there with new therapeutic solutions for whatever the case is, or what Tesla's doing, or what was the last thing Warren Buffett did. These are the decisions that we make. I'm going to sell 72,000 worth of my large cap growth. I'm going to buy $40,000 worth of large cap value. So step forward to yesterday. I redid this yesterday. And so it was 5.7 million, 5,790,000 on that date, 6,048,000 as of yesterday. Again, line the horses back up. These are the changes that need to be made. I had a bunch of bonds that matured in July and August, on the 1st of July and the 1st of August. So I needed to purchase some more high quality bonds. Again, emotionless decisions based upon what the portfolio does over time. So does that make sense?
Wait, show that, Chris. Now I know for Affinity Asset Management, we have 9 models that we have for various levels of risk. And I know you at the bank there, you guys also have your models. I think that's one of my opinions, kind of like the most underrated, maybe it's the best way to say, underrated thing that a financial advisor can create. There's so much technology and so much information out there that any financial advisor can create a set of models based on what their principles are, how they want to manage for a client. So I don't know about you, but I think I find over time that when I meet new people that are coming to us from another financial advisor, they have, they'll have 3, 4, 5 accounts, but they have 3, 4, 5 very different things in it. And it doesn't take much when you start asking some questions. Any financial advisor, you and I, we can sell investments. I mean, we know how to do this stuff, and we can show people performance and we can show them risk and we can sell investments, but it's not about selling investments. It's really about selling the concept of managing it. So I usually like to tell people, you should never judge your financial advisor in the past by what they sold you. You should judge your financial advisor by how they manage it. What are they doing to rebalance like you just showed? What are they doing to make tactical adjustments? Even if it's not to rebalance back to the initial way, it's a rebalance towards a slightly new way based on tactical little adjustments. And advisors don't do that. So every client out there has custom one-off portfolios, and it makes it very difficult for any financial advisor to manage that because they'll have no way of knowing if any one investment in that portfolio is doing really good or doing really bad. I need to buy this, I need to sell this. They don't have a way to know that because they have too many clients with too many accounts that are all different, unique, with all different investments.
Sure.
You see that same thing too?
Oh, absolutely. It never fails. We'll have somebody that comes in with a position, will accept a trust account, and maybe there's a big position, and I'm just going to use one, ExxonMobil, for example. And, they're emotionally attached to it because it's been a family holding for a long period of time, and they don't want to come out of that, regardless of the tax consequence. And so, so much of what we do is fiduciary. We take over a portfolio and we run it without input from either the grantor or the beneficiaries, because we're dealing with multiple generations. But we'll always have that one position where they're emotionally attached to it. And that's usually what adds that element of risk to the portfolio for us, that we have to figure out how to manage our way through. And that's ultimately, more often than not, the position that can disrupt a portfolio over time. Nothing. We've seen the value of oil change dramatically this year. We saw it actually move to where it was had negative value at a point earlier this year. And ExxonMobil is a stock that was absolutely thrashed earlier in the COVID period. It's rebounded pretty well lately, but having that single one-off position was something that caused dramatic stress for that individual, and it's something that they probably shouldn't have had to begin with.
Right on. I found over years that when I have a client request to keep like a stock or a mutual fund that maybe they used to work at that company or they inherited from somebody in their family, maybe there's some kind of sentimental attachment to that stock or that mutual fund, I'm not going to force them to get out of it. We can talk about the risks of having too much money in one place, and that causes risk. But if they allow me to diversify everything else and get everything else they have in the proper models, then I feel like they can have that one stock or that one mutual fund the way that they want to. So I don't want to be that jerk of an advisor that says, hey, you have to get rid of everything because I need to sell you everything all brand new. No, it's not really about that. If a person is not going to sleep well at night because I force them to do something that they don't want to do, there's a balance between me having to teach them the rights and wrongs versus if I don't get their business, they're going to go to another financial advisor who's not going to do nearly the job that we're going to do. So I might as well let them have that one position because it's super important. But if you understand where they're coming from, that makes a difference. So I think for me, if it's like a love or an attachment of some sorts, that's fine. Just as long as it doesn't lopside their portfolio, make their portfolio too crazy risk. I don't really mind that at all. I'm guessing you see the same thing from time to time.
I had that conversation with somebody 2 days ago on Monday when I was coming back from Colorado. I wanted to do something. And so my initial discussion with them is every reason why you shouldn't do it. That being said, this ultimately is your money. It's not my money. So if you make a determination that that's what you want to do, I'm going to figure out how to do it. And I'm going to make sure that we manage that piece the best way that we can. But I want to make sure that you understand, I'm going to play the devil's advocate and tell you every reason why you shouldn't do it. Not trying to talk you out of it, but just trying to make sure that you understand that you take the emotion out of that decision-making process and that you make that decision based upon what you believe is right. Because ultimately, Mark, it's your money, it's not my money. Does that make sense?
Absolutely. Well, at the end of the day, the problem is you and I deal with people, and people are not robots. And a lot of times people make decisions emotionally, and sometimes people make decisions financially. And I usually try to kind of sarcastically would say, I'm not here to appeal to your heart. I'm here to appeal to your wallet. That's my job, is to take care of your wallet, make your wallet fatter, protect your wallet from getting skinnier, things like this. But at the end of the day, we still have to be able to communicate with people and help them understand this stuff. And I find that even some of the really, really good financial advisors that are out there are not really, really good because they're handcuffed. So I don't really talk about this a lot in my public world with my clients, but you and I know this. I've bought a lot of practices from other advisors who either died or they were retiring. I've merged 4 of the practices over into my practice. And I do a lot of public speaking in front of financial advisors. And I do a lot of mentoring, a lot of coaching and mentoring every week with other financial advisors. And I find that their home offices handcuff them, because what's more profitable, that home office is going to dictate it down to them. and I don't want to throw any names of companies, but there's a lot of financial advisors out there that work for big name financial advisory companies that are always on TV and commercials. And you and I know a whole bunch of them. But I think questions people need to go ask their financial advisor is, one, can you create an efficient frontier for me? Two, is my portfolio unique to me, or do you have other clients in similar investments that I have? Because that should throw up a red flag. If they say my portfolio is unique, you and I want to have a unique portfolio that sounds neat, but at the end of the day, you and I know that we can't manage 500 clients all having unique portfolios. There's no way to monitor that. So you want to find out if your account is similar.
If it's unique to you, then why is it that everybody else isn't in exactly the same thing that you are? Why is that unique to me? That would be the question I would have. Why do you have me in stuff that only I have?
Exactly. And if another client has different investments and it's good for them, then why isn't it good for me too?
Mm-hmm.
It goes both ways, but I think that's not the typical rationale. And so I would encourage folks who are watching this video is go back to your financial advisor and ask if your mix of investments is, unique to you, or is it a similar mix of investments that a whole lot of your other clients have? And then another question I would ask is, does the financial advisor have complete autonomy to do anything they want with any investment out there, or does their home office give them suggestions? And when the home office is giving suggestions, of course, it's a home office. It's providing health insurance and 401k benefits to that financial advisor. It's profitability. It's what is better for that investment company. So I find a lot of folks are going to be heavy, like in one mutual fund company.
Mm-hmm.
I find people who have 10 mutual funds, but eight of the 10 mutual funds are all Fidelity, or they're all American funds, or they're all Vanguard, because of something that advisor is being told by the home office.
Right.
So have you ever find portfolios like that are really dominant in one group of investments?
Because we're a trust department as well, a lot of times I'm serving as a fiduciary in an account that's held at another financial advisory firm. Out of all of our, this, I've got portfolios that you manage. So I have some at some of those other unnamed firms that you've talked about. And, go back to what I was talking about the diversification and asset allocation model. I had a situation where we needed to add certain components to a portfolio that were not in the portfolio to begin with. And so I made some suggestions. We should use this fund. We should use this investment. And they would not let me because the funds were not approved by the parent company. And so when you go back and you start taking a look at the literature and why, they receive 12B1 compensation from fund families that they sell their products. Yep. And they did not have 12B1 agreements with these. And so they did not allow me. And these were well-known companies. This wasn't some unknown,
You're talking about investment companies, advisory companies?
Cohen and Steers is a real estate company. They would not let me buy Cohen and Steers funds because Cohen and Steers does not pay them 12B1 fees.
Yeah.
Cohen and Steers is the largest manager of real estate in the world. Explain that to me. It doesn't make any sense. But because I was told that you could not buy Cohen and Steers funds for your real estate component at this particular at this particular brokerage firm.
Well, so it's interesting that you brought up your past. Since you did, I'll bring up a little bit of my past and confirm what you just said. My first 12 years in the business was working as an independent financial advisor, but through a captive company. So I ran my own office, ran my own show, paid my own bills, had all that kind of stuff, but I had a parent company over me. Mm-hmm. That parent company did push me to sell a certain group of mutual funds in their portfolio. They don't want these other mutual funds. They don't want ETFs. They don't want stocks or bonds. Push mutual funds, push annuities, push this or that, because that's what there was profitable then. And not only did I get it from the home office, I got it from the manager over us, pushing us. Finally, to the point where as I continue to grow, the writing's on the wall. I don't want to be a puppet where they're pulling my strings. I want to be able to do what I think is in the best interest of the clients. And I don't want to be deluded that I have to do the same thing for my clients, that a brand new rookie advisor being told by the home office has to do the same thing. I have way too much staff. I have way too much technology. I have way too much experience to be forced to do the same thing that some rookie brand new financial advisor with our company is having to do.
Yeah.
So I left that company and for the obvious great reasons, and I don't regret being a part of that company, but it was a great decision to move because it's all about the best interest of the clients.
Well, we've talked a little bit, or you've talked primarily about other financial advisors. And the one thing that I would encourage people to look at is in having those conversations. One of the things that's always attracted me to you, that one of the reasons I think that we're friends, we both put the customer first. That is the most important piece of the relationship. And when you have that conversation with a financial advisor and their modus operandi is that their firm is the best or that their investments are the best, I think what you'll find if you drill down into it is they believe that they are more important than the customer is. And I think as long as we always put the customer first, we always deal with their emotional aspects first. They've built, this, whether it's a portfolio or, business or whatever the case is, they've built this with the intention of it being part of their life, being there for their kids, their grandkids. It's multi-generational. They've built something. And that something is what ultimately is most important to them. And if you and I or any other financial advisor treat that as it's a pool of money that we get to play with, I think that ultimately completely doing a disservice to those people. And it's one of the things in all of the conversations that you and I've ever had, it's putting the people first. The grantor or the owner or whatever the case is, the customer is the most important part of the equation. I think as long as you approach it from that standpoint, you're going to be okay.
Absolutely well said. Well, hey, let me ask you this. Let me get your opinion. I've said this a couple times earlier on some things I spoke on, but I want to get your opinion. So as a kind of like parting comments before we turn off here for today, what questions would you encourage the average investor who's watching this video? What questions should they go back and ask their advisor from your perspective?
Well, a few weeks ago, you and I talked about the difference between a fiduciary and a commission-based financial advisor. That's the first place I'd start. And there are a lot of fiduciary fee-based advisory firms out there. You see the commercials all the time. But that's the first place I would look is, how am I paying you? If I'm the customer, how am I paying you? Number one. Number two, the thing that I would look for is for somebody to talk to me about what's important to me, not about what's important to them. Talk to me about my family, talk to me about my kids, my grandkids, my great-grandkids, charitable endeavors, the things that I'm trying to build. Talk to me about estate planning, talk to me about those issues, and not talk to me about, here's my portfolio, I've got the greatest performance in the world. If performance is what ultimately leads the conversation, you're walking down a bad path. That's my opinion.
I think it's fabulous. I would echo all of that. I've already said a couple other things earlier. I think it just boils down to finding an advisor that it's not just about the relationship and how you bond personality-wise, but it's what they can and can't do or willing and not willing to do. And I say one of the biggest things is if someone listens to me do a public speech someplace and I talk on a topic and they're literally telling me that this is the first time they've heard this, but they've been with their financial advisor for years, then it makes you wonder, what are all the other things that your financial advisor is not talking to you about? So you want your advisor to be there for you when you're asking questions and you need to get those questions answered, but you really want that advisor to kind of get to know you as a person and be proactive at sharing information with you. This is something we need to talk about. We haven't done this yet. We need to talk about this. We need to talk about that. Social Security strategies, Roth conversion strategies, tax saving strategies, how to create income streams. We need to be proactive. A very good financial advisor is going to answer questions, but to put other ideas in their head and teach them. Because most people, flat out, they don't know all the questions to ask. Right. And most people don't know what they don't know. Mm-hmm. Well, let's finish on that. Chris, buddy, thank you so much for joining here today. Everybody, thank you for joining. We do our Community Cafe live every Wednesday at 8 a.m. on Facebook Live as well as Zoom.com. And To get on Zoom, that means you're receiving our emails, and it has the link on it that you can click on that through that link. Again, go out to Facebook, to our Community Cafe page, if you would, please, and click to follow us. And that way you can get your updates automatically popping up on Facebook to tell you about our videos. And if you can't watch it live, no big deal. It pops up in your news feed later. But just want to say thank you so much for everybody joining here today. We look forward to talking to you next Wednesday at 8 o'clock. Chris, thank you so much. Have a great rest of your day, buddy.
God bless.
All right, we'll see you.